Welcome back to another episode of the Startup Therapy Podcast. This is Ryan Rutan, joined as always by my friend, the founder and CEO of Startups.com, Wil Schroter. Wil, you've done it. I've done it. Most of the startup founders we talk to have done it. We've put money in. We've accumulated debt. We've run up credit cards. We've done lots of things in the name of building our business that were not in the name of our own financial security. When do we get paid back? How often in the history of history do people get paid back for this stuff?
If we're talking about when do investors pay us back for all the money that we've put in, it's right after never. That's the thing. Again, this is, we always joke about, nobody put this in the instruction manual, nobody put this in the brochure. There's this idea, and I think it's a reasonable conclusion. It's just completely false, and that's what we're going to talk about today. I think there's a reasonable conclusion when we start a business that if we borrow money or invest money from ourselves, that money will get paid back, or at least could get paid back. So the idea is, hey, I've borrowed, let's say this, an actual loan. I've borrowed $50,000 from a bank, maybe an SBA loan or something like that, and I got to pay that back. So when I raise capital from investors, they're going to help pay that off, right? Or I took out money out of my home equity loan, just different version of a debt, and I'll get paid that back, right? And what we find out over a way too long period of time is the answer is no. And so today, let's talk about all the things we will not get paid back and why.
What do you think are the most common ones? Like if we think about the ways in which we accumulate this money, like when this debt runs this money, what are the most common ones at the early stages?
Typically, it's going to come from either a salary or a loan. Say loan, it doesn't have to explicitly be a loan. It's just money we took out of somewhere, whether we borrowed it or whether it was in our savings account to put into the company, how in the company. So let's break them out separately, okay? The first one is obviously salary. And here's the thinking. The thinking goes something like this. I was making, let's say, $150,000 at my last job. Doesn't matter what the numbers. I was making $150,000 at my last job. And now I'm only taking $50,000 salary. Obviously, I'm going to need to get paid back for that $100,000 that I didn't get paid.
Just a couple of quick catch-up payments, no big deal.
Right. Now, before we go further into it, I think what's kind of interesting is who we have those conversations with. They typically involve our spouse if we have one. They typically involve each other as co-founders, right? Hey, Ryan, you put in $50,000, I'll put in $50,000, and we go raise more money. We'll get that back so we can keep growing the company. It sounds pretty good.
Well, it's definitely always feels better to be diluted with someone else, right? Like if we're going to be delusional, better to have a friend.
Sure, but I also think we make like an implicit pact. Let's say we go back to our spouses, right? You go back to your wife, I go back to my wife, and we both say, hey, we're going to take $100,000 out of our 401k or our kids' education fund, or it doesn't matter, right?
Don't worry, we're going to go raise funds and we'll get that money right back.
Or we're going to go rack up credit card debt, which is the most likely outcome. But again, we're like, that's okay, because that's just to get us started. Once we get a little bit bigger and we start raising some money, it's all good. Investors will help us pay those debts off and we'll be good. We actually believe that, except it doesn't occur to us that no one ever said that was true. Kind of a big bet to make.
There's a really important voice missing from those conversations. The people that you thought were going to give you the money to pay it back, right? Talk to your spouse about it. Talk to your co-founder about it. You might want to talk to the people who are going to write the checks that you think you're going to reduce by the amount you want to be paid back.
The challenge is those people aren't in the room yet because they're a couple years out or whatever our timeline is. Right now, you and I are just thinking about quitting our jobs and starting this thing. So the person, like you're talking about, the expert that we need to give us the answer actually isn't present and doesn't become present until about the most inopportune time in this whole process, when we're out of money and we need money.
And when they're there to tell you that, no, they're not going to let you take money from that investment to pay back those debts.
Here's what this looks like. A few times a week, Ryan, you and I get somebody that comes to us, a founder that we're trying to help raise money. And they say the same thing, and I get it because you and I have been there. So we get it. They say, hey, look, up until now, I've normally got paid $150,000 salary in my last job, but for the last 8 or 2 years or whatever the time frame is, I've only been paying myself $50,000 or maybe nothing. So obviously, I'm going to need to be made whole for that because that was an investment. And second, I've got $50,000 sitting on my credit cards right now, and we took a loan out from whatever company for another $50,000. The company owes those. We're obviously going to have to pay those back as well.
This just happened a couple weeks ago. I stumbled across a Slack conversation within the startups.com community where they were having this discussion on, hey, yeah, we're all in this same boat of having taken out a bunch of money. We're all about to raise funds. Let's figure out how we get paid back this round, right? Sadly, my very succinct answer was 2 words. You don't, right?
Yeah. Which sucks.
It's an awful answer. It's an awful answer, but it is the answer, right? So just because those investors aren't in the room when you're making those deals with your spouse, with your co-founder, doesn't mean that if they were in the room that they would have gone, yeah, that seems reasonable. Let's go ahead and do that.
That's the thing. So in our minds, the company can create a debt, and that debt is required to be paid back. So you'll talk to an accountant, and this is hilarious. Here's what they'll say. Oh, don't worry about it. Just take whatever debts you're creating, you put those on the balance sheet, and now the company has to pay them. They're on the balance sheet.
They're on the balance sheet. Yep. One more voice added to the conversation that still isn't the right voice, correct?
Yep. That would be called an IOU never.
Yeah.
That's when it's going to get paid. And we talk about this, and again, we're laughing about it. For the folks that are in this right now, the folks that are hearing this for the first time, they ain't laughing right now, right? Those folks are like, wait, are you guys serious right now? Because you seem pretty cavalier about something that's pretty disastrous for me. I'm laughing about it, and maybe you are too, because I've lived it. Right? Like I went through this same assumption.
Yes. Yeah. I've heard this more than once. I was like, fool me thrice. What is that one? What's that one called?
I had this idea. So I'm going to go many moons ago. I'd started a company, and we were raising venture for it.
Years would be easier. This is going to take forever.
Yeah. Decades. And we started a company, and I'd put in, let's call it about $200,000 of real money, right? Not like, hey, this is money I wasn't otherwise getting paid.
Foregone salary, some sweat equity, right? No, this was cash from somewhere paid into an account.
Yeah, exactly. Yeah, no, this was actual cash. Yeah. And so we go to raise money, and we're doing our seed round. It was like maybe a $1.5 million seed round. And we go to the investor, first investor who is gung-ho to invest. And as we present our financials, we basically say, hey, we've had $200,000 invested so far, right? That's part of this, et cetera, et cetera. And he looks at me like I've got 2 heads. What? I don't care how much you've so far. Now, when he says that, he's a good guy too. He's a friend of mine, right? What he was saying is, that money is gone, dude. And you're the only person that doesn't know it. And I'm like, huh? I was proud.
Even now that you've said that, I still don't know it. That doesn't make sense to me. Why is this happening?
Dude, I was proud to tell him that this money's a bit investor, that we need to recoup their money. Because guess what? The moment he puts in his money, he's not going to let anybody forget that. He's like, dude, I put in $1.5 million. I got a preference on that. I'm getting that back, etc. And I'm like, why wouldn't that work the same for me? And this is where you'll start to learn that it's all about who's investing next. And that person doesn't give a rat's ass about who invested last, particularly the founder round, if you will. The founder round tends to evaporate every time.
Yep. Oh, the founder round isn't even really around, right? And look, to be fair, right, let's back up on that a little bit. Are investors doing this because they're mean, cruel, evil people who want to see you suffer longer than you need to? No, they're just trying to make their money make money, right? Same thing you're trying to do, right? And remember, when you put your $50,000 in credit card debt in, you also had 100% of the cap table. You were incentivized to do, right? And to your point, once these things are done, they're done, right? We are not filling buckets with water that's already passed under the bridge. And that's exactly the point you're making now, right? Which is that the next investor round doesn't care what happened in the previous round. They just they want to understand, what are the deal mechanics for me? What am I going to get from this?
You bet. And to be clear, it's particularly that founder round that gets squeezed. The founder round being, again, we're just calling it the first money that anybody's ever put into it. You typically our own money, right? And again, I'm also lumping money and time to be the same thing. Going back to what we said a moment ago when we said $150,000. Let's say, Ryan, you and I are co-founders. We're both making $150,000 in market. We haven't been paid for the last year. There's a $300,000 total debt that exists at the company that needs to get paid back vis-a-vis our investment.
Stick on this for just a second, because I think this is really interesting. It's a great point here. It doesn't matter how believable the calculation is, whether it's, oh, this is true market salary, or this is money that I put in from my checking account. I emptied my 401k. I took a loan from Granny. The point here is it doesn't matter because it's not getting paid back anyways. That's it. So it doesn't matter how much we justify it, how much our accountant says it's real, how much grandma remembers it's real. It's not real for anybody else.
It does. Yeah, it actually doesn't matter. And so as we try to justify this more, we say, hold on, investor person, you're telling me that if Ryan and I invested $3 collectively in another startup, that we could get our money back. That would literally be the preference payment or anything else like that. But if we invested in our own startup, we can't get it paid back? And the answer is 100% yes. And it makes no sense on paper until you understand the rest of the equation, which leads us to, why would an investor invest in something where they have to pay back debt? Okay, so let's zoom out a little bit and let's look at things from not our eyes. We're well aware of what that looks like. Let's talk about it from the investor's eyes, okay? First things first. Ryan, if you and I say that we are investors and we've got a check to write, how many new friends are we about to make?
Oh, all of them.
Right. If you're in so many people coming to you with deals, which means you have options, lots and lots of options, right? So a good professional investor that does this well, does it for a living, and there are only so many, but they exist, could look at as many as 10 to 20 decks a week, maybe more, depending on who they are. If you're looking through 10 to 20 deals on a given week, 2 of them have some bizarre IOU that the founders have written to themselves, so basically anchor that they've attached to this deal. Why would you spend time on that deal if there are 18 other deals that simply don't have that problem?
This is, can we say this 2 or 3 more times? Because this is super important, right? I think it's so easy to forget when we're out stomping around with our pitch deck and we're presenting our deal to people. We forget that this is a competitive environment, right? So to your point, there's 10 or 20 other decks that they're going to look at. Do you want to be the 1 out of 20? Let's just say all else held equal. Let's say you were one of the top 3, right? And then you go on and on about this money that you need to get paid back and these decisions that you made that you're no longer happy with and you want to rectify with their cash. Where do you think that puts you in the overall rankings at this point, right? Do you think that might impact the decision of the investor? It's interesting to me, and I don't think this is something that we've talked about before, but do we even introduce this into the conversation, right? You and I would argue no. I would argue no, because we know it's not going to get paid back anyways. But it's not one of those questions where it's, you're probably not going to get paid back anyways, but it's probably worth asking. In my opinion, curious to hear yours, I would say it's probably not worth asking, because if the most that's going to come of this is going to move you somewhere down in the list, because they're going to go, hey, if I've got to bet on 2 people in a race, they seem to be wearing the same gear, one of them's carrying a boat anchor for some reason, right? I think I'm going to bet on the other one. I'm just going to guess here, right? That maybe that one's going to run faster.
You know, something that's really funny about everything we talk about here is that none of it is new. Everything you're dealing with right now has been done 1,000 times before you, which means the answer already exists, you may just not know it, but that's okay. That's what we're here to do. We talk about this stuff on the show, but we actually solve these problems all day long at groups.startups.com. So if any of this sounds familiar, stop guessing about what to do. Let us just give you the answers to the test and be done with it.
I actually lived this firsthand. So after I'd done the deal where I'd put in a couple $100,000, and the investor did end up investing, but completely forgot about my $200,000, right? Never saw that money again. The second deal, we were at the goal line, at term sheet stage, in a great position with a big name fund. It was first round. It was Josh Kaufman's fund, First Round Ventures, right? Another great fund. And first round had a term sheet. We were negotiating through. Everything was great. We were really excited, and I've always wanted to work with Josh, and I've always wanted to work with that team. And we get to the goal line, and I'm like, yeah, among the co-founders, we each need to be at about $150,000, give or take, on salary. And they were like, you're raising $1 million. And we're like, huh? And they're like, you're saying that you're raising $1 million and you want to take literally half of that in the first year and pay 3 people with it? And you're like, is that a problem? Now, you got to understand, I hadn't done this enough yet to understand. And this is exactly why we do these podcasts, right? It's why we have startups.com. So other people don't have to learn this lesson in real time in the middle of the game, which is exactly what I did. I looked like a complete amateur.
Yeah, that's exactly it. And it calls everything else into question at that point too, right? And they're like, what else do you not know about life? Lots, sir. I'm 22.
How deranged is this guy otherwise? And it was a fair question. And they bailed. They bailed on that point. It was disastrous for us because we had to restart the whole round. We had to go back out. Fortunately, we ended up doing it. Now that I think about it, the person that bailed us out was Founders Fund, but not the way I wanted to go. Massive egg on our face with all the other investors that were participating at the time because it looked like amateur hour. And that's the thing. Again, why would I have known that? Why would I have known that?
You wouldn't. I made basically the exact same mistake. It wasn't a venture round, it was an angel round. And I wasn't taking a lower salary at that point. I'd never really had a salary up until that point. This is the first business. But in my use of funds, like one of the things I had done was taken on some credit card debt, which I think a lot of us have done in the past. Taken on some credit card debt, and I was struggling to keep up with that and make the rest of my ends meet. And so I, as part of my proposed use of funds, but I didn't want to say pay off my credit card debt. Those were personal credit cards. So I figured that doesn't make any sense. So I'm just going to, one of the use of funds was bump my salary. And I forget the way it was put to me. The male investor sitting across the table from me says, okay, so I see here you want to use some of these funds to increase your salary. Like, yes. He's, okay. How much of a percentage increase are we talking about? It's this. He's like, okay, what are you making now? And I said what the number was. And he said, okay, so here's how this is going to work. If I decide to invest, what you're making now will be exactly what you're making after the investment. Like, I don't think he was trying to tease me or bait me, but I was leaning in just like waiting, okay, maybe this is going to be even better than I'm expecting, or maybe I'm going to have to negotiate a little bit. And he's like, no, you're going to be making exactly the same amount of money that's not enough for you right now will be exactly what you're making after the investment, should I choose to make it.
That reminds me of the
but how would you know? Like, again, like you don't know these things. You don't know these. There's no way to know.
Yeah, I was going to say that reminds me of the classic where the guy like I'm going to put a figure on this piece of paper and slide it across the table. And that's exactly what this is worth to me. And you flip it over, it's $0.
$0. Yep, that's it. Here's your salary bump, right? Let me write it down for you so we remember it clearly. Awesome.
Okay, but let's take it back to the invest. Talk about why they're looking at this so incredulous. Let's go back to first round, right? First round's a storied firm. It's a great firm, right? They have a million places they can invest. And we were fortunate to even be in a conversation with them, much less get a term sheet with them. But we blew it. We blew it because we didn't understand a very basic fact, which is lots of people want their money. It's not even specific to first round. You could apply this to tons of, really almost anybody with a check. But we had a golden opportunity with a great firm, and we blew it. We blew it because, again, we didn't understand that they have 50 other choices. They don't have to cater to our one-off delusions. That's the cool thing about being an investor. You don't have to do it now. Now, let me talk about it from the other side, where investors actually feel this same crunch, and I'm gonna get into a down round, okay? Of investing is the famous phrase, she with the gold rules, right? The golden rule, she with the gold rules, which is to say, whoever currently is putting in money sets the terms. If they don't like what the previous terms were, the valuation, the people's preferences, etc., here's what they say. They all go away. I will not invest. You do not get my gold unless everything is reset to my terms. Now, the first time you're going to feel this is the moment you go to raise your first money. And now the golden rule applies. The new person coming in gets to say, here are the new terms. Now, here's where this happens to investors. For folks that aren't familiar with this, because it's happening everywhere right now, everywhere, because the startup landscape for investing is so frozen right now. Here's what's happening. Ryan, let's say you and I went out and we invested in a company at $100 million valuation, okay? And at the time, we felt good about it. Maybe we put $10 million in at a $100 million valuation. We got 10% of the company. Cool. But that was 2 years ago or so, maybe 3 years ago. And the company's done okay, not great. Now that company is going out, it's going to raise more money. But the new investor comes in. And new investor says, hey, I don't really care what you invested at last time. Suckers, that was your problem, right? I'm going to invest $10 million at a $30 million valuation. And whatever you had a moment ago is gone. And we're going to argue, wait, no, hold on. We still got our $10 million in there. We need to be able to get our chunk of it, et cetera. And they're going to say, good luck to you.
Yeah.
They're going to say, here's the deal. You want my money? Then whatever deal you got, and remember, we're the investors in this case. It also applies to the founders. Don't care. New money, new rules. And so that's essentially the game that gets played. We're seeing it for the first time when we touch our first investor.
Yeah, and because there aren't really any analogs where this would happen. There isn't really any other situation where this would occur in an early stage startup that I can think of where we would feel that type of pressure or be forced into those kind of decisions, right? I think that really is. When we start to take on money, that's why we talk about this a lot, right? Is why we talk about the complexities of even deciding to take on capital because of these things, right? And especially because in a lot of cases, these are the reasons people wanted to take on capital. Why are you raising? I've got this debt I need to wipe out. Forget that, right? So are you not raising now? Because that wasn't going to happen. So now how do you feel? And so it's so important to have these conversations.
And again, if you and I had invested in that first round, right, like that $10 million at $100 million valuation, okay, we're going to try to fight with the new investors, that next round of money, to maintain our terms as well. And we're not going to get them because we might have said, which would be pretty standard fare, that we have a $10 million preference on this investment, which for those that aren't familiar, just simply means that if the company is to be sold, we get a $10 million check first before any other money gets divided up by percentages or anything else like that. So we basically get our money back first, and then we also get whatever percentage we have, okay? If that next year comes in, and that next investor is like, dude, I'm investing at a $30 million valuation, right? I'm investing $10 million. I'm not going to have you have a $10 million preference and you get a third of the company if it sells for 30. Like your preference goes bye-bye. Now remember, you and I put that money in explicitly with the understanding that if the company ever sold, we'd get our money back, and we just got wiped. Okay, so that happens at every round. Now, next investor, the one putting in at this next round, here's what they say. You don't like it? I got lots of other options right now. Right?
Keep your equity, right? Keep it at that previous valuation, right? But at that point, right, and this is the thing we have to understand, like there's a reason the company's raising money at that point, right? It's not just for grins. They needed cash for some reason, right? They needed it. They needed it to grow. They needed it to succeed. They needed to even stay alive. Whatever it is, it doesn't matter at that point, right? It's very rare do we see a startup who's raising in conditions like that, particularly where you're facing a down round, where it's positive circumstances. We're doing so well. What we would like to do right now is go out and raise on a lower valuation, just as a gift to the world.
It's crazy. And let's talk about what are some strategies that people try to hand us that tell us, oh, here's how we can get it back. And the one that I heard early on, and I remember it was from like a good friend of mine in college. His father was an accountant. And he was like, hey, this isn't hard, man. Just make sure that any money you put into this, that you put on the balance sheet. Here's where things get a little bit gnarly. When startups, founders are getting into the business of starting companies and they start taking advice from people who are an expert in a field that aren't an expert in a field in the startup business, right? Lawyers, accountants, you name it. In other worlds, what they're about to tell you makes total sense. It just makes no sense here. And it's actually geometrically horrible advice that can lead you to ruin.
It's going to give you a sense of security. It's going to make you think, or maybe make you make a decision. Because if you go, look, I'm willing to take this short-term risk on liquidating portion of the 401k, all the 401k, whatever that is, because the accountant told me, put that on the balance sheet. And then, of course, I got to go succeed and I have to go raise that next round, but I'm feeling good about the business. I feel like we're probably going to be able to do that. Other people are telling me it's likely we're going to be able to go and raise those funds. Cool. I'm willing to take that much risk, but I'm not willing to let that money sit out there until I sell the company, which could be 5, 10, 15, or never years from now. And we make a decision based on that advice, right? And when that's where these things start to go wrong, you go, okay, cool. Now I get to that point. Again, you're having that conversation with the investor and they're like, yeah, no, remember the part where you didn't ask your CPA for the $1.5 million? That's why I get to answer this question and not him. So this is where I get really worried for founders when they start to make decisions that are different than what they would have otherwise done. And they would say, look, I'm willing to risk some money to do this, but I'm not willing to risk my entire 401k knowing that I can't get it back under any circumstances. Like that I can't do, right?
And look, again, the advice is always well-intentioned. I'll give you another example of just really well-intentioned, horrible advice. It's when you talk to an attorney and they're like, hey, before you send this pitch deck out to anybody, make sure you get an NDA signed by every investor. And I think to myself, has this person ever raised money?
They may have done you the favor of keeping you from raising funds, right? Depending.
Oh my God. It's the worst advice you could possibly give to a startup. If anybody's hearing this for the first time, just because we're here, no one will ever sign an NDA.
No. Why would you? Why would they? What's in it for them?
Yeah, it's the worst advice ever given by really well-meaning but unseasoned attorneys.
But Will, it's not an NDA. It's an MNDA. It's a mutual non-disclosure. I also agree not to tell them any of your secrets that you're not going to tell me in the first place. Yeah, it's so funny, man. There's so many of these types of advice where, again, they're not ill-intentioned. They're not even bad advice in the right place. But it's if I ask somebody, okay, look, I'm running downfield and I'm getting close to being in a position to score, and my teammate passes me the ball, what should I do? Like, square up, catch it with both hands, and pull it into your chest, right? Great advice if I was playing American football, but since I'm a soccer player, I'm just going to get a red card and be thrown out of the match, right? Great advice, wrong fucking game. This is the problem.
Yeah, exactly. Yeah. And just, again, well-intentioned. But in this particular case, we're using the same kind of advice. I see people come to us all the time. They say, I talked to a CPA, talked to an accountant, and they said, this is no problem. They said, you just need to put this on your books as a debt that you will accrue every month. Now, like any debt that exists for anything in the world, a debt is only as viable as your ability and willingness to pay it back. So, Ryan, if you and I start the company and we both agree that the $150,000 that you didn't get paid, the $150,000 that I didn't get paid, will go into a deferred comp account, and we have to pay off that liability over X number of years. If we both agree that debt is valid, and we both agree that as the company grows that we'll pay it off, cool. Because it's in our best interest to actually do that. It's just not in anybody else's best interest to ever do that. No one cares, right? And so I think when we go into this and we're thinking to ourselves, oh, hey, these big investments that we're making. And look, Ryan, these are serious investments, right? Not being able to take comp, especially through some of your higher income earning years, is dangerous, right? Pulling money out of your savings, which anymore is hard to even have, is dangerous. Like we've been talking about, to do it on that assumption that we're getting it back in the way that we think we're getting it, like the investors are going to bail us out.
Yeah. And look, we're not making the case to not do these things, right? You may need to pull money out of your savings. You may need to forego comp. In all likelihood, you will. It's not by choice. And but specifically we want people to understand what the outcome of that is. And that there isn't an outcome whereby investors just start to get together and they're like, we really should consider how to pay those fellas back, right? They've put in so much time and effort, and I've just got all this money that I don't know what to do with. Let me just throw them some. You know what? Let's just tack on a little extra, right? It just doesn't happen. It's as ludicrous as it sounds.
Yeah, no one cares. No one cares. Now, again, a couple of small caveats, right? There is no downside to recording all of this debt, right? There really isn't. To show how much you've put in, to show what sits out there. It's like a fun conversation piece, but in the history of history, I have never, in my 30 years, both running 9 companies myself, helping thousands of companies, I've never, ever seen anyone ever get paid back. On top of that, I think when we try to saddle our own effort, in other words, when we say, okay, hey, I'm raising money, I'm raising $1.2 million, part of that is we've got $300,000 in a previous debt to a previous investor that they need to get paid off, right? They need to get squared up, right? Same thing. We've been talking about the debt back to ourselves. If we try to layer in anyone else's debt, it's just as bad, right? It doesn't really matter who the debt is to. The point is investors aren't here to bail you out. Like, they may be angels, but they're not saints. You know what I mean?
It's absolutely. Yeah. And look, like to your point, like you go and acquire another company, let's say. We've done this a number of times. Sometimes those folks had assets and liabilities, right? We go to the next round. We're like, hey, investors, we bought a couple of companies and one of them had some debt. So during this round, we're going to wipe that debt out. Now, there may be a strong case for why that would actually improve the financial position of the company, maybe. But they're basically going to come back with that same answer, which is, hey, remember that part where you signed the documents and bought that company, but you didn't involve me and I wasn't there to tell you what I was going to do? I'm going to tell you what I'm going to do now, and it's not pay the debt that you accumulated or accrued or acquired.
Yeah. So the $1 million question here, quite literally, how do I get paid back? Okay, I did put that. Are you telling me it's gone? The money's on fire? Not necessarily. Here's how you get paid back. You sell the company.
Yeah. Do what you set out to do.
You sell the company and or you grow and make it, and it has a ton of profit and distribution. That's it. All those investments, whether we were willing to recognize them for what they were at the time, which was essentially an investment to get our equity, to make our equity have some level of value, that's how we cash in. The downside is no one told us at the time that this was a one-way street, that's a one-way investment. But if we're being honest, if we're going at it from the very beginning, no matter how much we've put in, no matter how much we've sacrificed, etc., the only way that we're ever going to get this money back is through the sale of a company or some sort of liquidity event. And Ryan, I'm sure I speak for both of us when we say, I hope to hell you get that money back and you get that liquidity event, because that's what this is all about.
Overthinking your startup because you're going it alone? You don't have to, and honestly, you shouldn't, because instead, you can learn directly from peers who've been in your shoes. Connect with bootstrapped founders and the advisors helping them win in the Startups.com community. Check out the Startups.com community at www.startups.com to see if it's for you. Could be just the thing you need. I hope to see you inside.